In this video, I'm going to explain why I prefer to sell options rather than buying options. I'm going to give you the different reasons that push me to be more of an option seller rather than an option buyer. You'll see that there are different reasons, and of course there are good sides and bad sides to everything. There are good sides to being an option seller, but there are also negative sides that are going to cause maybe some option sellers to lose money, and vice versa. It's always like this for everything. But I wanted to make this video so as to show you what are the different reasons that convince me of being an option seller, mostly at least, and hopefully it's useful for you if you'd like to do the same. But before diving into this video, as always, if you find this video interesting or helpful, please don't hesitate to subscribe to my channel and liking this video. That's the best way to let me know after that in my analytics that you like this type of video where I share my opinion on some stuff and you like to see more videos like this one. The first reason that I think is very nice when you're an option seller compared to being an option buyer is because of the time decay. For those who wouldn't know what the time decay is, well, basically options lose a tiny bit of value on a daily basis. That's how it works. Every option over time is going to lose value because there's literally value in time. The more time that there is to expiration, the more time value, that's how we call it. Every day that passes, options are losing a tiny bit of value, and the closer we get to expiration, the bigger that amount that they're going to lose on a daily basis. And that's called the time decay because literally there is a decay as the time goes. That's why we call that time decay. And if you're familiar with the Greeks when we talk about options, that the time decay refers to theta, the Greek letter theta, and that's how it's going to be shown usually in brokers. That's going to be shown under theta. That refers to the time decay. And as I said, the closer you go to expiration, the bigger the time decay. And I'm going to give you an example so it's completely clear. Right now, we are in the Testworks platform. It's the broker that I mainly use, and we are in my portfolio where I trade options. So you can see that I have different positions here on, for example, Gap, Wells Fargo, Dropbox, United States Steel, American Airlines. And what you can see is that you have this column, theta, and that refers to the time decay. And what does that mean? Well, the numbers that you can see for each and every single line represents the amount of money that I'm earning on a daily basis thanks to the time decay. So for example, for Gap, the first line, you can see that I earn $1.50 and 54 cents per day. And that number is increasing as we go to expiration. I'm sure that you already saw, for example, this type of graph that represents the time decay over time. The closer you get to expiration, the bigger the time decay becomes. Meaning that as we get closer and closer to expiration, I'm earning more and more from the time decay. And basically for each and every single line that you can see in this option portfolio, I have sold options on each and every single position. That's why all the lines that you can see here from the time decay, they're all positive because as I sold options for each and every single trade that I have in this portfolio, then I'm earning money from the time decay for each and every single position. That's why you have those positive numbers. If I had bought options instead of selling them, you would see a negative number. You would see a negative number, and that's because you lose money when you buy options. And that's one big reason why I like to sell options compared to buying options, is that even though you might not be right in the stock's direction, let's say that the trade goes against you, at least you're earning money just by actually being there, just because the time is passing. And that's very nice because sometimes, and actually very often, what is going to happen is that yes, you're going to have trades going against you. However, with the time decay that goes, we are going to earn money. And if you stay in the trade for, let's say, for example, 20 days, then at least you made some good money. And if the trade comes back in your favor, you're going to see that your break-even point is going to be actually a lot closer, and you're going to be able in a profit very easily. That's why the time decay is very nice. And I don't think that there is anything wrong with actually buying options. You know, you can also make money by buying options. However, you need to be aware that the time decay is going to hurt you on a daily basis. That's why usually when you buy options, you want to be right quite quickly because you're going to have the time decay that is going to make you lose money. And compared to selling options where we're not really in a rush to be right, because just the fact of having the time going, you're going to earn money thanks to the time decay. So that's why I personally really like to sell options just because of that. After that, don't get me wrong, I'm not saying that the time decay is going to solve all of your problems. If you're really wrong, the trade goes against you, you know, the stock loses, I don't know, 30% 30% overnight, you can earn like $1 a day. It's not going to save you. You're still going to lose money. However, this is the type of differences between selling options and buying options that I think is really nice to know and to benefit from. For example, right now we are in the June 18 expiration for the SPY, and I'm pretending like I'm buying, for example, the 407 strike for the 407 put, and so I'm paying, for example, $532 if I was buying that option. And you can see that the time decay theta, as you can see within the green rectangle, is of $12 per day, meaning that right now, if I buy that option, I'm going to lose $12 a day. And that number is going to increase as we get closer and closer to expiration. That's why usually if you want to buy options, you might want to go to longer dated expiration, because that's where the time decay is going to be lower compared to closer dated expiration. In other words, if you buy an option that is expiring, let's say in 15 days, the time decay is going to be a lot bigger compared to an option that is expiring, let's say in a year. You're going to see huge differences in terms of time decay. That's why I think if you like to buy options, you might as well want to go for longer dated expiration. Even though you buy a bit more, you have to purchase a bit more premium, but at least you won't lose a lot of money thanks to the time decay. You won't be as impacted by the time decay as if you had bought a closer dated option. The second reason why I like to sell options mostly compared to buying options is because of the probability of profit. You see, when you sell options, you tend to have higher probability of profits, meaning that you're going to win more often. It doesn't mean that you're going to necessarily make money at the end, but at least you're going to have more winning trades compared to having losing trades. And usually when you buy options, you tend to have lower probability of profits. In other words, it's not uncommon when you sell options to have, for example, 8 trades out of 10 that are going to be winners, and it's not uncommon when you buy options that you're only going to have 2 or 3 trades out of 10 that are going to be winners. That's just how options work. When you buy options, you tend to have lower probability of profits. But when you win, when you buy option, you're going to make a lot more. Compared to when you sell options, you might win quite often, however, you won't earn as much as someone who bought options. So that's why it's a trade-off that you want to have. So basically, it's a question of which trade-offs are you actually fine with. Personally, I think that it's a lot more manageable on a day-to-day basis to have 8 winners out of 10, even though you don't win as much, you don't earn as much, compared to having only 2 or 3 winners out of 10, even though you earn more compared to selling options. I think it's much more manageable, and personally, at least personally, that's only my opinion, I found that selling options and having higher probabilities of profit is much more manageable, even though you don't earn as much. After that, if you're ready to have, for example, 80% losers and 20% winners when you buy options, well, fair enough, you might want to go for buying options if you're fine with that. Personally, I think that it's very, very hard to maintain that on the long term if you only keep buying options. You also want to sell options so as to have higher probabilities of profit, because just mentally speaking, I think it's much more doable to deal with a game where you win 80% of the time compared to dealing with a game where you win 20% of the time. But that's only my opinion. And if you're fine with that, fine, fair enough. But personally, I think that selling options has a huge advantage just because of this. And there are several reasons why you tend to have higher probabilities of profit when you sell options. The first one, as I said, is that you have the time decay that is working in your favor. Meaning that if you, for example, sell an option, you don't even need to actually be right in the direction if you sold a very far out the money option. Just the fact of having the time decay working in your favor might put you in profit enough so as to have a good winner in the end. So in the end, you don't even need sometimes to have the stock going in your favor. Just the time decay is going to make you earn enough money. The way I see options is very, very similar to an insurance business. And this is actually what options are. This is just a very big insurance business where anyone is participating. But initially, that's like an insurance business. The insurance business makes money by selling options. For example, if you buy a car insurance, well, you're going to buy an insurance that is also going to expire in a year. You're going to pay a premium for that. And if a crash happens, if you have a car accident, then the insurance business is going to pay for that because you will have exercised your option. Well, you see that it's very much similar to options trading. It's just that it's a bit different. But as an insurance business, you make money by selling options, and you basically bet that you won't have that many people who will have car accidents, and in the end, you will end up profitable still. And that's exactly how it works, and that's why I'd rather sell options, because I'd rather be the insurance business who sells options, who has a very high probability of profit, and sometimes you have a big loser that eats your profit, but hopefully at the end you're still profitable. I'd rather be in that position rather than someone buying options who essentially is like an insurance buyer. Because if you think about it, you don't necessarily expect making money off an insurance. If you, for example, have an accident, you don't expect making money out of it. You might make money out of it. However, you buy an insurance so as to cover unexpected events. You don't necessarily buy an insurance so as to hopefully make money from it. That's not really how it works. And that's really my philosophy for options. It's really the same as an insurance business. I'd rather sell and be the insurance business who sells the insurances rather than the one who actually buys the insurances. And that actually leads me to the third reason why I'd rather sell options compared to buying options. And that's actually quite related to that insurance business philosophy. The third reason is that implied volatility usually tends to overstate realized volatility. So I'm going to explain because right now it doesn't seem clear at all, but I'm going to explain it, don't worry. What does that mean, the implied volatility overstates the realized volatility? Well, the implied volatility is basically like a thermometer. It's basically telling you how expensive or how cheap option prices are. And the realized volatility is actually what happens in real life. What is the actual move of a stock? And what we tend to see usually is that the implied volatility, so how options are priced, they're usually priced too high compared to what actually happens, compared to the actual realized volatility. What does that mean? Well, it means that usually we tend to pay too much for options compared to what they're actually worth. Because usually the expected move that we were expecting to see is not as big as what we forecasted. Meaning that options tend to be too expensive compared to what they're actually worth. And I think that's Tasty Trade who had done a study like this, and they had shown that basically the implied volatility tends to overstate realized volatility around 80% of the time. Meaning that 80% of the time, options are usually too expensive compared to what they're worth. And there are good reasons why they are usually too expensive. People usually buy options exactly as an insurance. People who have long stock portfolios, for example, let's say that you have a long stock portfolio, you have all of those stocks, you earn dividends from that. The way to protect yourself from a potential crash is to buy, let's say, for example, a put option on the SPY. In that case, if the SPY crashes, you will make money on your put option. Hopefully, that will set off all the losses that you will have had on your stock portfolio. That's usually why people are going to buy options. They're not necessarily going to trade options. They're going to buy options as an insurance in case of a crash, for example, or in case of a down move. That makes the option prices more expensive compared to what they're actually worth, but that's normal. When you buy an insurance for, let's say, your iPhone, let's say that you buy an iPhone insurance, and God knows that they are very, very expensive, but of course the insurance is quite pricey, even though you have a low probability of seeing the iPhone breaking. Hence, it makes options more expensive because people are willing to be protected against a potential down move or potential crash, whatever it is, so they buy those put insurances so as to hedge their long stock portfolio. However, we know that crashes are not happening every 2 weeks. I mean, it's quite rare that when you see a crash. So what happens usually is that most of those options expire worthless, meaning that usually they tend to be too expensive compared to what actually happens. And that's normal because if everyone buys, very far out the money puts, well, we're not going to see crashes every 2 weeks. So most of those puts are going to expire worthless. Most of those insurances are not going to be actually used. In that case, that means that options are just too expensive compared to the actual move. That's why we talk in terms of implied volatility overstating realized volatility, because that's normal. What we expect, and that's why people buy insurances so as to protect themselves from a crash, usually doesn't happen. That's why they are too expensive compared to the actual move. However, don't get me wrong. The day where there is a crash, they're going to make a ton of money and that's going to be amazing. They will have hedged successfully their long stock portfolio with the puts that they will have bought. However, 80% of the time, they will lose money on those insurances because usually crashes don't happen every 2 weeks. And when you take the place of an option seller, when you take the option seller's position, that's actually very nice because now you are actually benefiting from a normal edge because people are going to buy options so as to hedge their long stock portfolio. And you, if you take the other side, you sell options, you're going to win a lot more often, which makes sense because 80% of the time, options are too expensive compared to what they're worth. So as an option seller, it's normal that you're going to have a higher probability of profits, and you're going to make money that way. However, when a crash happens, that's usually where option sellers are going to be in trouble, and that's where option buyers are usually going to be in a much better position. So you see that both have their pros and cons. Like, option sellers have their advantages, but option buyers also has some advantages, meaning that during a crash, they will be protected compared to option sellers who will mostly be hurt by very big movements. But personally, I think that just because of the high win rate that you have when you are an option seller, it tends to be better. At least personally, I'd rather be an option seller because of all those reasons: time decay, and also the implied volatility overstating the realized volatility, compared to being an option buyer. After that, doesn't mean that you cannot make money as an option buyer. For example, there are very famous traders that have been making money by buying options. For example, Nassim Taleb is known to make money only during crashes, meaning that he's only going to buy very far out the money puts, so he loses money on a yearly basis. And that's exactly the concept of an insurance. When nothing happens, he loses money. And when a crash happens, he makes so much money that it actually covers all of the previous losses, and he even makes money on top. And that's what happened in March 2020. That's how he made so much money during the crash. So you see that it depends on what you want and what you're actually fine with. If you want to be more active, I think that it's better to sell options because you will have a higher probability of profit. But if you're also fine with buying options and play the tail movements, then it's absolutely fair. But it's just up to you and what you're actually fine with. I hope this video will have been insightful and it will have brought you some reasons why I like mostly to sell options. After that, as I said, buying options also has its advantages, but personally, I'd rather be an option seller compared to an option buyer. If you have any question, or if you have any comment, or you agree or you disagree, I'd love to hear your thoughts, so don't hesitate to comment it below. I'd love to hear what you have to say about that. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.